Good morning. My name is Steve Hunsberger. I'm the Executive Director of the Indian Valley Chamber of Commerce, and we are happy to be with you all this morning for our annual tax update. This year's update was a little bit more challenging than other years. Congress was really having some difficulty at the end of the year getting some legislation passed, and I think the presenters will probably talk about that a little bit today, but we're glad to have you all with us, and we're glad to have our sponsors with us today. Particularly happy to have our sponsors, Harleysville Bank and Canon Capital, with us presenting. And I would like to introduce our friends from Harleysville Bank, and then Harleysville Bank will introduce our panelists. So I'm happy to introduce Scott Little. Scott is Vice President of Commercial Lending with Harleysville Bank. He specifically provides business owners and commercial real estate investors with the funding that they need to be successful, whether it's to expand their business or purchase a building. And his responsibilities include managing a commercial loan portfolio and providing quality service for his borrowing clients. Scott started banking way back in 1992 in the marketing department of a local Indian Valley community bank, and this is marking his 30 years of banking in this industry. And on an interesting side note, back in 1992, Scott and I were, well, I was going to say we're colleagues, but he was actually my boss for a very short period of time, and have been very happy to have known him for the last 30 years. So Scott, I'll turn it over to you for some introductions.
Thanks, Steve. We're hiring, by the way. So if you wanted to come back and work with me, that'd be awesome. So on behalf of Harleysville Bank and Brendan McGill, our president and CEO, who couldn't be here this morning, I want to thank everyone for joining us. Events like these are important to the business communities Harleysville Bank serves, and we're grateful to be co-hosting with our friends at Canon Capital today. Harleysville Bank will be celebrating our 107th year as an independent community bank next week. We have 7 branch offices along with a commercial loan department and cash management services for our business and real estate investors. We're proud to say that during the pandemic, we provided over 479 Paycheck Protection Program loans. We're even prouder to say that 99% of them have been completely forgiven at this point. Those loans equated to $37 million reinvested in our communities and over 3,700 jobs saved. I speak for myself and the rest of our loan department at how happy we would all be if we never hear the letters PPP ever again. And I think my friends at Canon Capital would agree as well. So collectively, all of us on this call, our business has been through one of the most challenging times in history. Harleysville Bank's proud to say that despite the challenging environment, our challenging rate environment, we produced another year of strong financial results, and I'm happy to send those results through our annual report to anyone who wants to. Otherwise, you can listen to me go on and on and on about them. But enough of that. It's my pleasure now to introduce our speakers today from Canon Capital. Give you a little background. Canon Capital Management Group, LLC, provides integrated financial and business services to businesses, individuals, government entities, and nonprofit enterprises. Canon Capital has built a base of satisfied clients that trust their competent and capable professionals with estate planning, financial planning, investments, tax reporting, payroll, technology, and business consulting needs. Our presenters today, let me get my notes out, get this right. Our presenters today will be Stephen Moyer, CPA, PFS, CGMA, CSEP, owner and director of tax services, Canon Capital Management Group. Steve started with Canon Capital in 1999. He's been practicing public accounting for over 30 years. That seems to be the theme, 30 years in business. He's a member of the American Institute of Certified Public Accountants, the PA Institute of CPAs, the National College Advocacy Group, and the AICPA, Personal Financial Planning and Forensic and Valuation Services. Brent Thompson, a CPA, CMA, CGMA, owner and manager, Canon Capital Management Group. Brent joined Canon Capital in 1998 and was admitted to the company as a unit holder in 2018. He's responsible for providing management advisory services, tax and general business planning, tax preparation, financial statement preparation, and review services for numerous businesses and their owners. His CPA designation, he also holds a certified management accountant designation and a chartered global management accounting designation. Our final presenter today will be Chuck Porter Jr., owner and senior investment advisor with Canon Capital Wealth Management. Chuck has been with Canon Capital since 2006 and was admitted to the company as a unit holder in 2018. He's a senior investment advisor specializing in serving high net worth individuals and families. He has a certificate in financial management for the family office from Pepperdine University's Graziadio School of Business and Management. He's accredited as an investment fiduciary. Welcome our friends at Canon Capital. I'm going to turn off my video and gentlemen, take it away.
All right, thank you, Scott. I appreciate that. Just need to share my screen here. I guess I'll want to start video as well, so you can see me. First off, Steve, we're hiring too, so we'd appreciate you considering us as well. First off, and then Scott, really kudos for getting through the bios here. I tried myself, and it was pretty hard. So kudos to you. So Steve, Chuck, and I have our good pajama pants on. I think we're ready to go. And I would say if you have questions, we'll text that or chat them into Steve, and I'll try and remember, at the section breaks to see if there's questions that were chatted in, because we're supposed to be dealing with a little bit of a larger group today. But here's what we're going to cover. I'm going to try and cover lightning round, 10 minutes or so. Where are we at? 8:07. Let's target 8:20. And I'm going to go over current state of affairs. And then Steve Moyer is going to get into the meat and potatoes of the program here. And then Chuck Porter is going to come in and give us a bonus section, value added here for retirement plan overviews and stuff. So that's what we're going to cover. So let's get started here. Again, I mean, lightning round, current state of affairs on a broad scope. There's just an identity crisis out there. We have the PPP program and the ERC program, and these were great incentives for the businesses that needed help. But then they were trying to turn around and raise minimum wages and taxes and take money back away from businesses that they were trying to help, right? And, we all know that individuals need to work, but the benefits kept them home. So we're dealing with that. Now that has led to supply chain issues, So we have all the money out in the economy. We have so increased demand, but we have less labor, supply shortages, more money, less goods. Inflation's going to continue. And, Steve will cover it, I think, in a little bit, but, they were trying to pass even more legislation. And I think there's a lot of money from COVID relief. I don't have time to go into it, but there's tens of billions of dollars, if not, pushing well over, actually, I'm sorry, hundreds of billions of dollars left of, on COVID relief that won't hit the economy until this year or after. So, I don't know that we're going to see much of this going away soon. So that's kind of the backdrop for businesses. They're having difficult times. I've talked to a couple restaurant clients, and I'm telling you, my heart has never broken, more in my career from, I don't know, when did I graduate? 92. I graduated from college. So, my heart just has never been as heavy for businesses, as talking to restaurant owners right now, because they're getting hit with everything. Certainly a segment that really still kind of needs help. And if we do see legislation, I think it's going to be around them. In terms of this upcoming filing season, just real quick, nobody cares, but CPAs, these are our concerns, and you can see the IRS operations is by far, our main concern. And quite simply, the IRS right now is a horrific mess. This is a little dated, but as of last year, they had 7.9 million paper filed returns as compared to 239,000 at the end of 19. I have a little bit more updated here, but amended payroll tax returns, they're not being processed. They're leading to erroneous errors and messages and notices and stuff, and all that stuff's automated, and they haven't turned that off yet. There are starting to be rumblings of them flipping the switch and turning off the automated notices and penalties and stuff. But to date, they have not done that, but there is starting to be some rumbling. Their staffing shortage, they're still out of the office. You call and you get what they're terming as a courtesy disconnect, right? So I'll show you in a second the phone volume that they're not answering. And, again, at one time, I don't know what this is down to now, but they had millions, I think upwards of 11 to 20 million of unprocessed correspondences that they had rented storage containers to keep in, So this is a mess. Now, people do admit it. The National Taxpayer Advocate, so these are people that are supposed to be on your side, helping you resolve problems independent of the IRS, even though they work for the IRS. I'm not sure how that works, but regardless, the Taxpayer Advocate said, there was no way to sugarcoat it. 2021 was horrendous, without a doubt. And even the IRS commissioner said, we're unable to deliver on the amount of services that people deserve and need. So there is some kind of acknowledgement, but as we know with government, there's no competition. So I don't know what's going to come of it. But this is what they're dealing with, and I have mixed emotions. I'll leave it at that. Somebody that deals with the IRS every day, but you can see in 2010, their budget was 12.15 billion. It's now down to 9.8 billion. That's about a 20% decrease. And you can see their full-time employees in 2010 as compared to now, that's another 20% decrease. So their budget and their employees are down, but the number of processings have gone up. Certainly with electronic filing and stuff, I don't know that that's as much of an issue. I'm more worried about exams and notices and stuff not getting resolved. We could sit here for the whole hour and have, conversation of, stories, if you will. We could have story hour of the IRS. We got a notice that we didn't like your W-2s. We're not going to tell you what we didn't like about it, but we're going to assess you an $8,000 penalty, and you can't get somebody to answer the phone, or give you any information, and they're going to go ahead and, impound refunds and, try and get that resolved. So it's just a mess, right? So here's a little bit more recent stats. They didn't finish 19 returns until June of 2021. Again, 9.8 million returns in error resolution right now. 11 million math error notices right now estimated. 2.3 million amended returns that they have yet to process. So of their calls, here we go. They were only able to answer 32 million of 282 million phone calls, 18%, okay? If we did that at our businesses, we'd be out of business real soon, So, and, for comic relief, here's another government website. I think we have a pretty good track record there with government websites. This website had one job, right? And it couldn't do that. So that's where we're at. There is penalty relief at the IRS. They did extend for these counties for Hurricane Ida relief. And believe it or not, we're still filing, I'm going to get my years mixed up, 2020 returns until February of 15th. I've got 4 returns yet. I don't know if the clients are going to show up and behave, but I could file a 2020 return in the middle of 2021 filing season and still be timely, right? So that's never happened before. You know, there's additional relief for some other states. They have started to revise installment agreements and expand reasonable cause, you know, administration things, you know, for abatement of penalties. But again, it's a mess. So I think the point here is, you know, hopefully none of you are having trouble, but if you're dealing with customers and this is relevant and they're saying they have trouble, please believe them and give them the benefit of the doubt, because I'm telling you, it's kind of a mess right now. Scott, sorry to do this, but here's some PPP stats as of January. You know, I saw reports of, you know, in excess of 800 billion that was given out. I've seen reports of over 100 billion in fraud. So, you know, as of January, there was still 2.1 million applications needed to be filed yet. And if you have gotten a PPP loan, you should know by now you do have to apply for forgiveness. So, you know, that I'm happy to say that we're done, I think, with our client base. We got it done before tax season. So that is not hanging over our head for summer. So one thing I do want to camp out on that, you know, with 5 minutes I'm going to have left here is the employee retention credit. And please, 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 this is something, you know, I feel fairly passionately about because you'll understand in a second. But basically, this was a credit that was available for 2020 and 2021 for the first first 3 quarters for 2021 for existing businesses. And it was available up to $5,000, a $5,000 credit per employee, and $7,000 a quarter in 2021. All right, and we do have 3 years to claim that credit. So if you find that you're eligible or haven't had this discussion yet or don't know anything about it, you still have time. All right. There's a ton of rules, but basically you are generally eligible in 2020 and 2021 due to either a reduction of receipts or a full or partial government shutdown. All right, now the reduction of receipts in 2020, it was 50% as compared to the same quarter in 2019. In 2021, it is 20% reduction, over 20% reduction as compared to the same quarter in 2019. So if either your first, second, or third quarter of 2021 had reduced receipts in excess of 20% for this same quarter in 2019, you could potentially be eligible for up to a $7,000 credit per employee. These things were huge. We have a number of clients, I think, that probably got more in employee retention credits than they did PPP loans. All right. So to do this, you'll have to amend your personal and business returns to claim the credit in the year that it was the wages basically made you eligible for the credit. So there has to be a matching. There is some interpretations out there on being able to file when you receive it, but to me, my personal opinion, and I think Steve would agree with this is really an extremely flawed position that I've seen so far. Very, very strange. I want to talk just a little bit about this. It was largely ignored. This employee retention credit was largely ignored by many, many firms and payroll processors. So what had happened is, you know, I'm going to throw accountants under the bus in general terms for a second, but tax season comes along and we just tend to put our heads in the sand and we go, we don't want to talk. We don't want to know anything. Don't bother me. I'm working. I'm so busy. I don't have time for anything. And it's really, really a flawed issue. if you will. So, you know, I know there's something called the employee retention credit out there, but I'm not going to pay attention to it until after tax season. Well, you couldn't do that, right? So the first part of our Canon Capital's filing season last year was going back and doing these employee retention credits, because what happened in December of 2020, right? The original CARES Act came out March of 2020, and it said you have an option, but you can't do both. You have the PPP loan, which is certain, it's free, and it's here for you, or you could do the employee retention credit, but you would have to have a reduction in receipts and payroll, and you know, you may not qualify for each quarter and blah, blah, blah. You know, so a lot of people, everybody rushed to the PPP program, but they passed the law in December of 2020 that said, okay, you can now do both, however, and you can do it retroactively. But what happens is when everything comes out in January, CPAs put their head in the ground and they're off and running. And this was really, really largely ignored. The one potential, too, is nonprofits are eligible for this. Churches or places of worship have huge potential of having fallen through the cracks because they don't have tax reporting. A lot of times they don't have financial statement reporting. So they may or may not be working very closely with a CPA. So they have really, really huge potential of having fall through the cracks. I've had staff work on our churches. We have payroll services here for about 130 companies. Of that, we have 28 churches that we do, and I've had staff working on that, you know, for pretty much a couple months straight this summer. So one other quick thing with the time I have left is the recovery startup business. You know, this ERC was such a big thing. They in March of this year, they said, okay, we're going to extend it for third and fourth quarter in March of 2021. But then by November of 2021, they said, whoops, we can't do this. And they did it retroactively back to September 30th. So this thing was huge. And, but they left recovery startup businesses eligible for the fourth quarter of 2021. And basically, you don't need the government shutdown or partial shutdown or restrictions. You don't need a reduction of receipts. You're allowed up to a $50,000 credit if you started your business after February 15th of 20, your annualized receipts are under $1 million. You'd be eligible for up to a $50,000 credit in third and fourth quarter of this year. So that's what's out there for new businesses. I really wish I had more time, but you know, we'll have to leave it at that. You know, you have our contacts, you know, we'll do questions and stuff there, you know, but we could talk, you know, the whole hour on this. And lastly, there is still some idle programs. They're not as attractive as they were. They really kind of ended that on December 31st. But it's still out there, non-COVID in disaster areas. You know, the SBA has to determine that your business is unable to find credit elsewhere. And, you know, so that may be a little bit difficult. So the idle stuff may be done here. So at this point, I'm going to turn it over to Steve and let him get into the meat and potatoes of the tax update here. So.
All right. Well, thank you, Brent. Thanks for running through that quickly. And I want to echo what you just said. You know, these topics, we could be spending, you know, hours on each one of them, and we're trying to get through this, you know, as quickly as possible to get you as much information as we can. I do want to just, you know, probably I'll have to one up Scott and Steve and give away my age. This is my 37th tax season. So that bio that you read was a little bit old, but anyway, so yeah, the first slide here, what happened in November with the tax update. We were planning on doing this back in the end of 2021, and things just didn't go like everybody thought they would. There was this Build Back Better bill and the infrastructure bill that kind of got held up. They got split apart. The infrastructure bill got signed and went through. The House passed a Build Back Better and sent it over to the Senate. And then the government was in, getting close to their having to pass their budget. So they had to extend that to February 18th. Debt ceiling issues, all kinds of things that happened that we just decided that it was not, feasible to do an update at that point. So we will discuss the Build Back Better, what's happening with that a little bit later. And before we get to the next slide, I just want to give you a little bit of a tax bill history from the past 5 years, just to set the stage, because even though we don't have a bill that came into place at the end of the year, we're actually dealing this tax season with 4 different tax bills that were passed over the last number of years that are going to affect our 2021 tax returns. So just to give you a little bit of a history real quick, Tax Cuts and Jobs Act was passed and signed December 22nd, 2017 by President Trump. That kind of changed it was a huge, massive bill, reduced the tax rates for most people, increased our standard deduction. We'll talk a little bit about that in a little bit. So that was a huge bill. And then, so that started in 2018. So we had that for 2018 and 2019. And this is not information that's on the slide, so I'm just adding that just to give you a little bit of history. Then the COVID hit in March of 2020, and the government passed the CARES Act, which included the PPP loans that we were talking about and some other items. That was a $2.2 trillion stimulus bill signed March 27th, 2020. And then also in 2020, the Consolidated Appropriations Act of 2021 bill was signed 12/27/2020. All right. And that also was it was a stimulus and a spending bill, $900 billion in stimulus. And that was signed by President Trump. And then in March 11th of 2021, there was the American Rescue Plan, signed $1.9 trillion, signed by President Biden, March 11th, 2021. So there's the 4 bills that we're dealing with in this tax season. All right, so Brent, if you want to go to the next one, we'll start now in what is going to affect our 2021 tax returns. Virtual currency is become a big issue with the IRS, and it's become more mainstream. You start seeing ads on TV and things like that for Bitcoin. So virtual currency started out in 2019. There was a question on the tax return, but it was back on Schedule 1. A lot of people didn't need to even answer the question because they didn't have a Schedule 1 in their tax return. And then in 2020, they moved it to the front page of the 1040. And they had the wording in 2020 was, did you receive, sell, exchange, or otherwise acquire any financial interest in any virtual currency? So they had the wording acquire in there, and that was confusing to a lot of people. So in March of 2021, the IRS clarified that you can answer no to this question if you purchase virtual currency for cash. So this year's question changed the wording to say, did you receive, sell, exchange, or otherwise dispose of any financial interest in virtual currency? So virtual currency for tax purposes is considered to be a capital asset, and it's treated as a sale or exchange whenever you use it. So it becomes, if you go out to the store and you go to a Wawa, I think even now accepts it. You go and buy a hoagie at Wawa and use virtual currency. That's actually a sale that needs to get reported on the Schedule D and 8949. So it's a complicated issue, and there's going to be in the infrastructure bill that was signed by President Biden, there's also additional reporting requirements that's going to come into effect for next year. So, all right, Brent, you can go to the next one. So, as I mentioned earlier, the standard deduction was increased by the Tax Cuts and Jobs Act, and 2021, the standard deduction is now up to $25,900 for a married filing joint. Last year it was $25,100. A single person is $12,950 for 2021. So a lot less people now take the standard deduction rather than itemizing. So one of the things that was added with the Consolidated Appropriations Act bill is charitable contributions can now be claimed for non-itemizers. Married filing joint can do $600 and $300 for single. The Tax Cuts and Jobs Act also had a limit on your AGI as to how much charitable deductions you can take. The Consolidated Appropriations Act changed that so you can take up to 100% if you itemize of your charitable donations against your income. So it's for those that are really charitable, that's a huge deduction. I'm going to skip over the home office for now and just keep going. Unemployment benefits this year are fully taxable. In 2020, there was a $10,200 exclusion of unemployment benefits. Meals and entertainment. I don't remember which bill, if it was the ARPA or the Consolidated Appropriations Act, increased the meals and entertainment for meals purchased at a restaurant. So they increased it. This is for businesses. They increased it and made it 100% deductible in 21 and 22 to try to get some more people going out to restaurants But you don't have to eat your food in the restaurant. It's also for takeout. So keep in mind for you business owners, you want to make sure you separate what you purchased through, at a restaurant. Keep it separate from those that are, you go out and buy a prepackaged meal at Wawa. That's doesn't fall under the 100% rule. All right, so a good increase for and a chance to get some benefit to the restaurants. Child and dependent care credits really increased for 2021. In 2020, the high amount that could potentially be deductible was $2,100. And in 2021, that potential is up to $8,000 for 2 children. So now I'm going to jump back to the home office, because on the surface here, it seems like a pretty simple one. But so Tax Cuts and Jobs Act got rid of the miscellaneous itemized deduction line on the tax return. And that's where, if you had a home office and you weren't self-employed, you could deduct that previously. So now, if you're, a work from home, when back in March of 2020, when everybody was sent home and couldn't go to the office anymore, this deduction isn't available. It's only available for self-employed people. So what we want to keep in mind here is that back when everybody was sent home, most states, so if we had an employee, or if you were a business and you had an employee that was remote working, and they lived, you're a Pennsylvania employer, and they had a vacation home or something up in Connecticut, by the ocean. Connecticut kind of looked the other way and, didn't tax that income. So a lot of states did that. They said, okay, it's temporary. We're not going to take the tax. That's a Pennsylvania employer. That's now, a lot of those things went away in this past summer. So there could be some issues with that. And states now are going to be looking for their income. So the key point here is you want to look at your work from home rules and make sure you have it set up so that they're worded the best way to not have to actually withhold another state's tax for those remote workers. Go ahead, Brent, to the next one. Just going to skip over this real quickly. 2020, for people that had IRA accounts and they were at the age where they had to take a required minimum distribution, in 2020 they were not required to take that. But now in 2021, they need to take the required minimum distribution. I'm not going to go through all the calculations. The age, the important part there is that the RMD age increased from 70 and a half to 72. And RMDs apply to most retirement plans, IRAs, SEPs, 401ks, Roth IRAs, and that's the benefit of a Roth, is you're not required to take a distribution while the owner is alive. In 2020, you were allowed to take a disaster coronavirus distribution, and you could have it spread over 3 years, whether or not you wanted to keep the money and pay the tax, or you could actually put it back in the account over 3 years and not have to pay. The point is, there was no 10% penalty on that. But we do have reporting if that was, taken in 2020. There's 3 years now of reporting that has to take place on the tax return. This next slide, this is where we can get into issues this year in tax reporting and tax filing. With the stimulus or the economic impact payment, and also the new child tax credit. The economic impact payment was authorized by the Consolidated Appropriations Act to give a $1,400 payment for individuals and each dependent. And that the description of the dependent increased from what it was earlier, changed it a little bit. I won't go into all those details, but you will get a letter from the IRS that's going to show, it's letter 6475, and those letters should be going out as we speak. They started the end of January, and they're going to be staggered because there's so many letters going out, of millions of letters to people. So anyway, the thing to keep in mind here is that if you got this stimulus payment and this year your tax situation changed and you really your income went up this year, and it was over the threshold amount, this amount that you got does not have to be repaid. You can keep it because it was based on last year's tax return. That's going to be different for the child tax credit, but there's also a loophole here that I don't think the government realized when they put this into place. So since it was based on last year's tax return, and a dependent can now be a college student, if that college student graduated in 2021 and now is filing their own tax return, they can qualify for this economic impact payment when they file their 2021 return. And the parents got one because they were their dependent last year. And so that's a little thing they didn't think about, I think. So they both get, and they both qualify for that. On to the child tax credit. This started in July. These payments started coming out, and they were direct deposited or mailed to qualifying taxpayers. IRS will be sending out letter 6419 to show that the payments were made, or what payments were made. The thing with these letters that you're going to have to be careful of is that there should be a letter addressed to, if there was a married couple, the spouse will get one and the taxpayer will get one, and they'll have the same information on it. So for us as tax preparers, we don't want to include that twice on the tax return. Anyway, both of these things can cause a problem if they aren't clearly put on the tax return as what was actually received and in the IRS's records, because it'll throw out the tax return, and then if it was filed with wrong numbers, and then somebody has to manually look at it. And that's, that'll add to the IRS's backlog. And I didn't mention these payments. If you qualified last year, but your situation changed this year, you don't get to keep the overpayment if there is one. So this could reduce your refund. So, and taxpayers could be surprised because of it. All right. Okay, this is another thing that came out, and it was put in place by the ARPA bill. So this has been around for a number of years. It's 1099-K reporting. And it's for third-party settlement organizations. So it's really to report payments by a business for the sale of goods and services. Okay, so through a PayPal, Venmo, or Zelle account. In the past, the amount was $20,000 in gross payments, and there was a $200 200 transaction threshold, so that you had to have 200 transactions before this was reported on a 1099-K. News came out that this was dropping down for 2022 effective, that the amount is now going to be $600. So there was a lot of confusion on this, and I think we have 2 slides on it, but really it is still for a business transaction. So if you're sending money to, you're going out to dinner and you're using Venmo to pay part of your bill, with somebody else, and you send them money, that's not supposed to be part of that $600. Okay, it's only supposed to be for business transactions. Now, there is a way to apparently turn this off, and I just found out yesterday. I was on a PICPA conference that Venmo has an off feature, which I actually just sent money to my son last week for some car repairs. I sent him a $600 amount. So I'm going to be interested to see if he gets a 1099-K next year, because I didn't know there was an off feature for Venmo. I think they each have different ways. PayPal has a way to tag it that it's a business transaction or a personal. I'm not exactly sure because I don't use that, but just to keep that in mind when you are using those types of things, make sure before you send it that you tag it as a personal item. So I don't have a lot of time here, and I don't think we need to take a lot of time on it, because we don't know a whole lot at this point. The Build Back Better plan, I mentioned it was cut into 2 back in November. It was like over a $4 trillion bill when it was starting, and there was a lot of disagreement on at that point not needing to put more stimulus money into the economy. And anyway, so it was split into, the infrastructure bill was a bipartisan, both Democrats and Republicans agreed on that, because that was the true infrastructure, roads, bridges, and things like that. The Build Back Better plan was more of a social infrastructure type bill, and so there's not We don't have both sides agreeing on this. So the House came back, just real quick, House came back, they were on recess. They now have to deal with that, with getting the budget passed by the February 18th deadline so that they can keep government running. And, you know, we've had these, AICPA has done a great job for us over these last couple of years. They've been, you know, town hall meetings, you know, so at one point they were weekly, and you know, even through tax season, we'd be jumping on there because we'd be getting a lot of information from them. Right now, they're like twice a week, but anyway, they feel that there's not going to be much happening until, you know, maybe later May or so, because at this point the bill just needs to completely be reworked. There's a lot of due dates or start dates that were back in 2021, and that's just not gonna, you know, they don't want to go retroactive on those things. So it's really pretty much kind of up in the air as to what's going to happen. I can't give you a whole lot, but there, you know, we'll just have to see where that goes and try to keep everybody up to speed with it. All right, that's it for me. And certainly any questions, feel free to send them in or reach out to us, and we'll be glad to answer them for you. Chuck?
Thanks, Steve. Hey, thanks, Brent. Appreciate what you guys brought to the table here this morning. And so the three of us work very closely together. I have the fewest amount of letters behind my name. So they kind of gave me the time at the end to fill in whatever time was needed to talk about a pretty big subject. Again, we could spend an hour talking about this if we really wanted to. So I have until what time? What time do I have until? Is it 9:15?
About 9:15.
All right, cool. So I'm going to talk about retirement plan options and considerations for small businesses. So I'm going to start kind of basic, and work my way and focus on most common plan types that we see in the investment advisory world for small businesses. So again, work on the investment advisory side. So if you just were to go out there and look for retirement plan options, you would find a long list of retirement plans available for businesses. There are qualified plans, there are non-qualified plans, IRAs, SEP, simple, solo Ks, regular 401ks, 403bs. So today we're going to focus on IRAs, SEP, simples, 401ks, and we'll talk a little bit about cash balance plans as well. Again, which of these is most, which of these is best for you and which of these is available to you depends on how your business is structured and, you know, how many employees you might have. So, but to get to that point, you want to look at what's most important to you in evaluating whether you need to start up a plan or whether you need to change the plan or evaluate the plan that you're already in. So, so what's most important to you? Important considerations would be administrative effort required to administer the plan. So if you are establishing a plan, you're going to be held accountable to follow the rules of that plan that you're in. So understand a qualified plan is, you're getting a tax benefit for that. So that means that there are going to be rules set in place by the IRS and ERISA that need to be followed in order to qualify for those tax advantages. So so again, administrative complexity, how much time do you have available to administer the plan? Do you have somebody on staff that can help you or somebody in your circle of advisors that can help you make sure that you're following the rules? Desired contribution level for you. So are you looking to contribute more than $15,000 per year or less? You kind of start there and that'll hopefully kind of steer you in the direction of which plans might be best. Desired contribution level for your employees. So Are your employees interested in contributing themselves? Or are you just looking to provide your employees with a benefit as a profit sharing contribution or a match? Is tax planning the primary motivation for establishing the plan, or is it more employee benefit retention? So, you know, and understand some employees come into this thinking they really just want to give themselves the most amount of benefit as possible, and they're not really interested in you know, giving their employees much, if anything. And some people look at it and say, you know, we've got a lot of employee turnover, and so providing this benefit might help keep my employees where they are. And you can do a lot of things around vesting, and that would hopefully help keep employees where they are. Cash flow flexibility requirements is a big one. So are you able to kind of commit to a certain level of contributions on an annual basis, or do you need to have the flexibility and not be forced to make contributions in a down year? So, you know, how established is your business? Is it a startup business? Or are you just starting this plan? Do you have consistent, you know, cash flow receipts that you can support contributions on an annual basis? Or is that flexibility of being able to not make contributions in a year with certain plans, you know, valuable to you? Again, eligibility thresholds and vesting. So certain plans allow you to not contribute to employees that are under a certain age or who haven't been there that long. Certain plans allow you to add vesting schedules, which again would not allow employees to walk away with company money if they haven't been there for a certain amount of time. Are you looking for more of a deferral-based plan, or a plan that just provides a profit-sharing contribution or a match? So again, deferring as a percentage of salary versus employer money as a profit-sharing contribution versus a match on whatever the employee were to put in as a deferral. And again, there's a lot of different options and plans available that would kind of hit each of those. Are you interested in establishing and promoting alternative plan features like loans and Roth provisions and hardship withdrawals? Again, and understand the more complex you get with adding alternative plan features, the more costly some of those plan options might be. So, you know, the simplest plans are gonna be the cheapest in terms of, you know, how much it might cost you to establish, start up, and administer the plan from a time and resources standpoint. You know, so if, you know, depending upon how important those things are, again, hopefully helps you kind of figure out which plan might be best for you. And then again, business structure now and in the future. So what type of entity are you now? Do you have employees? Are you owner only? Do you have employees that have, you know, union wages, or are you taking on union jobs? Again, all of those things would kind of factor in. So yeah, I put this out in front. It can take some time to set up a plan. So it's really best to look at a plan option in the first half of the year. And certain plans can't be established after October 1st. So if you're thinking that, you know, you'd like to set up a plan, or you might be interested in evaluating whether it makes sense to switch your plan, that's a first half of the year thing for sure. You're gonna have to go through the process of evaluating, and it takes a little bit of time. So I'm gonna take a step back and say, what is an employer sponsored plan? Because this is kind of where I started a long time ago. You know, understanding what that really means. It's a retirement plan. It's a workplace benefit offered by some companies to help provide workers with income in retirement. So at its core, it's a benefit, right? And again, we talked about, as a qualified plan, there are tax advantages. So if you look at it as a benefit, you have to understand that there are going to be rules and things that need to be followed. So the ERISA, or Employee Retirement Income Security Act in 1974, and the IRS guidelines kind of all govern the rules and responsibilities of a plan administrator as a fiduciary to plan participants. So again, our different plans are going to have different rules which need to be followed. So kind of important to understand it. So generally, all retirement plans are going to fall into two categories: defined benefit plans or defined contribution plans. So defined benefit plans are going to be are going to be entirely funded with employer money. They are designed to provide employees with a specific benefit calculated as a measure of salary upon retirement. So you have actuarial contributions and calculations that come into play, which determine how much you can put into defined benefit plans on an annual basis, most commonly referred to as a pension plan. The great thing about defined benefit plans is they typically allow much higher annual contribution levels, especially for older workers, than defined contribution plans. The bad thing is that the investment risk is assumed by the employer. So money goes in, it's typically held in some sort of retirement trust fund. It's a pooled money account where until the funds are distributed, it's invested on behalf of the employees that it's set to provide for, which means if there's got to be enough money in there to provide for the benefits that you're guaranteeing for your employees. So that means you assume the risk. So because of that, the employer guarantees that benefit. There will be a significant investment risk. And they are costly because they have actuaries that are involved and required to determine the calculation. So from a cost perspective, they tend to be the most expensive. From a complexity, they are the most complex. But again, if you're an older worker who's looking for the ability to make significant contributions to your retirement, they could be the best option if designed properly. So DC plans, so again, because of the risks involved, the retirement industry shifted away from the defined benefit pension plans a couple decades ago. So most common plan type that you see would be the 401k plan. So these are employee funded, sometimes with a match or profit sharing contribution. So again, that's a plan by plan basis. Each employee will fund their own account and will establish their own contribution percentages. So again, it's not pooled money. Each employee establishes their own account. They're going to bear the investment risk within that account by making investment elections themselves. So employer doesn't have that risk of investment loss on their shoulders. However, the employer is still responsible for administering a plan that follows ERISA guidelines. So that means you're responsible for selecting and monitoring investments within the plan and all service providers, ensuring that the costs of the plan aren't excessive. So you are acting as a fiduciary capacity to your employers by offering that plan. So again, two categories, DB versus DC. So let's click to the next slide. The first, so again, now we're going to go through kind of each of the options available from what I would say is is easiest, least complex to most complex. So the easiest probably way to do it is to provide a benefit for your employees, and it's not really an employer-sponsored plan, would be to allow them or give them the ability to make contributions to IRAs or Roth IRAs from their payroll. So there are ways that you can just kind of direct deposit from your paycheck into an IRA or a Roth IRA. Again, to that extent, you're not qualifying that they're eligible to make deductions. You're not kind of pre-qualifying that they're eligible to make Roth contributions. So you're just kind of giving them an avenue to be able to make that happen. So, or encouraging them to speak with somebody. So again, simplest, easiest to do. There's no tax benefit to the company. So would be a voluntary, not a mandatory thing. Just kind of steering them in the right direction. I've seen some employees kind of help our employers do this. Next slide. So the first real employer-sponsored plan is going to be a SEP IRA. It's a defined contribution plan and funded entirely with employer contributions as a percentage of compensation. So it's all employer money, but it is each employee does have their own separate account. So they kind of would set up how much risk they want to take, and they would establish the allocations of the account as a whole. Any employer can set it up. They can be less restrictive, so you can employ certain requirements as to who is eligible to receive those employer contributions, but it cannot exclude employees who are at least 21 years of age, employed in 3 of the last years with $600 of income. So if you kind of look at your employee base and you think about who you'd like to make contributions to, if somebody is over 21 years of old and they've had at least $600 of income in 3 of the last 5 years, they would be required to receive a contribution. And so whatever you're giving you want to give yourself as in terms of a percentage of compensation, you got to give everybody. And that's kind of the rule with SEP. So if you want to give yourself, the max is going to be 25% of compensation. So if you want to give yourself 25% of compensation, you'd have to give everybody 25% of compensation in SEP. So again, the maximum allowable contributions, the most you're going to get into a SEP in any given year is going to be 61,000. So again, that's going to be governed by how much compensation you make and the percentage that you set. So is that right? Yeah. Employee is immediately vested in all contributions. So there's no vesting schedules that can be applied, which means that there's no testing. So again, the key with these benefit plans is you have to make sure that you follow the rules. And there are certain plans that are going to have top heavy vesting or top heavy testing and ADP and ACP testing rules that come into play. So understand if you want to skew benefits more towards yourself, there's going to be plans that allow you to do that. Those plans are going to come with certain testing requirements. So the next plan, the next easy, again, this will be the next step up for a little bit more complex, I would say, is a simple IRA. This is a DC plan funded with both deferrals and employer contributions. So with a simple, you're going to have to make contributions to your employee either as a mandatory company match or as a profit sharing component. Eligible employers will be all businesses with fewer than 100 employees. Eligible employees are going to be those who have at least $5,000 of compensation in any 2 years before the current year and expects to receive $5,000 in the current year. Maximum employee contribution is going to be 100% of compensation up to $14,000 with an additional $3,000 allowed if over 50. So that's on the deferral side. So the employee is going to have to set a deferral percentage or deferral amount. The most that they can do on that side would be called $17,000 if they were over 50. On the employer side, so how much does the employer have to contribute? You're required to choose one of two options. So, and only $305,000 of compensation is considered for this calculation. So you'd have to either match 100% up to 3% of compensation, and that can be reduced to 1% for 2 out of any 5 years, or 2% as non-elective to all eligible employees. So you can, again, looking at your employee base, if you, again, depending on what the motivation is, if you don't think that your employees are going to make contributions, maybe the match is the better way to go. If you want to provide everybody with the same benefit, make it as easy as possible, that 2% non-elective contribution as a profit sharing is the way that I've seen a lot of companies do it. So again, depends on what your motivation is. The most you're ever going to get into a simple is going to be 2 times the maximum annual employee contribution. So that $14,000 as a deferral and the $14,000 as a match is generally the most that you're going to be able to put into simple. Employees immediately vested in all contributions, so there's no testing requirements. And again, this is one of those plans that has to be established by October 1st. So again, SEP, all employer money, simple is going to be deferral and either a match or a profit sharing. And so then we get to 401k plans, which is, in terms of flexibility and what you're allowed to do, this is where you're going to find a lot of your most flexibility. So it's a DC plan, defined contribution plan funded with both deferrals and employer contributions. Again, the employer contributions are not mandatory. Eligible employers would be all businesses, eligible employees. Most flexibility with regard to setting eligibility requirements. So again, this is the plan where if those alternative options, investing schedules, and the ability to exclude employees is important, you're going to find your most flexibility here. So maximum employee annual contribution is going to be 100% of compensation up to $20,500. You get an additional $6,500 if over 50. So again, it's a little bit higher than the simple, right? So you can put more as a deferral that with the 401k plan than you can in the simple. The maximum annual employer contributions, again, not required, up to 25% of eligible payroll, and you can make it as either a match, profit sharing, or both, or none. So again, you're in the max total contributions, like the SEP, it's going to be $61,000 or $67,500 if over 50. So the 401k is going to allow you to put the most money in. You can defer a higher amount, and it's a simple calculation. You can do 100% of compensation, and you can kind of create a match or a profit sharing calculation that works really well for your company. Again, you can impose vesting schedules and employer contributions, so you can kind of set how long the employers have to stay there in order to get the company money as the match or the profit sharing. There's also loans, hardship provisions, Roth, auto enrollment, auto escalation features. So you can add a lot of other alternative provisions to your plans. You have to file, again, this is where we get into this complexity. You're going to have to file an IRS 5500 form with the standard 401k. You're going to have to follow the ERISA and IRS guidelines. Understand you're a fiduciary to the plan. These are, highly scrutinized, and the more kind of complex and you get, the more important it is to understand the testing requirements. So, if you're going to add strict vesting schedules, and the more skewed you get towards yourself and any highly compensated employees, the more important it is, again, to understand that there are rules that need to be followed with testing, so you don't want to break rules, because the IRS and ERISA is definitely, or the Department of Labor is definitely looking at 401k, administrators as a way to kind of create revenue. Deadline for contributions is going to be December 31st for deferrals, tax filing deadline, plus the match or plus extensions for the match and the profit sharing. I did want to note the safe harbor rules. So there are safe harbor 401k plans. So if you have a 401k plan with safe harbor provisions, that would allow you to avoid some of those testing requirements. So if you kind of go into the 401k understanding, I want to make it as easy as possible for my employees to get the money. So if you follow certain rules, you can make it easier on yourself from a testing standpoint, and also from a cost standpoint. So, if you're not going to, if you don't want to put vesting schedules on it, if you want to provide your employees with a mandatory match every year, kind of like the Simple was set up, so kind of follow those rules as a general guideline. You can make it a little bit, cheaper and easier on yourself. So that's the 401k. Again, it's easiest to kind of get the most money into those plans. It allows you to kind of create a lot of different provisions for your business and your employees. So the solo 401k was kind of created as an offshoot for businesses without employees. So you could utilize all of those 401k provisions, same deferral, same match, same profit sharing ability. So it allows you to get the most money into the plan. You can find providers that will give you the ability to take loans from your plans. But the deal is that because you don't have common law employees, there's no testing and there's no 5,500 filing requirements until the account exceeds 250,000. So 250,000, if you're going to get into the solo 401k, that's a number that you want to kind of keep an eye on. There might be ways to avoid the 5,500 filing requirement. So if you're approaching that 250,000 mark, there might be some things that you can do to make sure that you don't cross it, to avoid that extra cost. But again, it's the most flexible, and they tend to be the easiest way to kind of give yourself the biggest benefit. So cash balance, real quick. So if you have if you're an older employer and you're looking to put $150,000 or $300,000 away for retirement for yourself, the cash balance is going to be a defined benefit plan, which works really well again with established businesses, decent cash on hand. Typically going to be paired with a safe harbor 401k plan. So you set your employees up with a safe harbor plan where you're providing them with a mandatory match or a profit sharing that you're going to contribute to them. And because of that, you're allowed to kind of create a defined benefit pension plan for yourself that's pretty well skewed. So again, these are very flexible with regards to eligibility, vesting, and contribution percentage allocations to owners. And a lot of times, again, if your employer workforce looks right, and you can get yourself 150 to 300,000 while providing the rest of the employees with a reasonable contribution, but not over the top. So again, because they're complex, because the actuaries are involved, there are top heavy testing rules that come into play. But again, we've seen a lot of success stories with safe harbor 401ks combined with cash balance. So again, so it comes back to kind of what's most important to you. I highlighted some of these items. So as you go through the process, kind of want to think about each of these items, what's most important to you, and then that should help you kind of land on what plan is going to be best for you and your business. So next slide. I just wanted to kind of touch on this real quick. So there are tax credits available right now for startup costs and auto enrollment within these plans. So if you're looking to start up a plan, there's a $5,000 tax credit available for 3 years for the ordinary necessary costs of establishing a plan and educating employers about the plan. So the qualifications are: you have 100 and fewer employees, receive $5,000 of compensation. You have one participant who is a non-highly compensated employee, and in 3 of the last 5 years before you're eligible to receive the credit, your employees were substantially the same. Employees receive contributions or accrued benefits in another plan sponsored by you. So it's the new plan, have 100 or fewer employees, and it's not all highly compensated employees. And again, eligible startup costs would be ordinary and necessary costs to set up and administer the plan, educate your employees about the plan. And you can claim the credit for three years, and you may choose to start claiming the credit in the year before the plan became effective. And there's calculations that come into play to determine how much the credit's going to be, but it's up to $5,000 per year for 3 years. And then there's also a $500 credit for 3 years for any plan sponsor who adds or creates an auto enrollment feature, which just says their employees are automatically enrolled into whatever plan you've got set up. So I kind of rushed through that. Hope I touched on everything. Any questions?
If anyone does have any questions, you can type them into the chat. I had asked a minute ago or so. I don't see anything. Let me look here real quick. And no, I don't think so.
Okay.
So we will send out contact information for everyone. And again, as I said, this program is recorded. So if you have any questions, you can go back and review the slides. You can send friends and colleagues to this site. So I want to thank, I do want to thank Steve and Brent and Chuck very much for their time this morning. I think this was kind of helpful. This was very helpful. It wasn't kind of helpful. It was very helpful. It kind of got us all settled into understanding where we are at this point. And the accountants are, I think, ready and off to run to the races for the next several months, and we appreciate your time. So thanks again very much to Harleysville Bank, Scott, Canon Capital Management folks. We appreciate your time. We appreciate your expertise. And I think that is one of the great things about this Chamber of Commerce, is that we have a lot of good folks who are very interested in helping each other. And I think one of the neat things is, if you're working with a chamber member, you're working with a reputable organization and group of people. So again, thanks Steve, Brent, Chuck, Scott for joining us. And I hope everyone has a good day. I hope you stay dry and get lots of work done and have a profitable end to the week. All right.
Thanks, Steve.
Thank you so much. Have a good one, everyone.
Thank you.
Bye.